Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I had him on, I think, in November of 2014. He's a very interesting person. He writes a great newsletter called Things That Make You Go, He's a former money manager. He also co-founded with Rayo Paul an investor education website called Real Vision TV. And he has over 20 years of experience in the financial industry. Grant Williams, thank you for joining me again.
Hey, Jason. It's good to be back.
Now, Grant, you put out this great video recently called Nobody Cares, and then I put in parenthesis about the gold market since I watched the video, and, basically you outline how tiny the gold market is. But you travel a lot more than me. How bad are things in the global economy right now based on your travels?
Well, look, I mean, I think what we're seeing at the start of this year is actually really interesting, and it's interesting for reasons perhaps that aren't obvious on face value. We've seen strong equity markets for a number of years now. We're 7 years into. I don't even like to call it a bull market. I mean, in pure number terms, it's a bull market, but against a backdrop of really poor fundamentals, and it's this whole rally has really been facilitated by quantitative easing. And we saw when QE3 finished, everybody was worried that it would mean the markets were going to crack, and they didn't, and everybody assumed that was okay. And if you look back now, you see that as soon as QE3 stopped, markets started to roll over, and it wasn't a crack. They didn't fall 20% like people were worried they'd do, and similar to what we got after QE1 and QE2. But they stopped going up, and they started going sideways, and they formed a pretty nasty consolidation top. And what we've seen at the start of this year, I think, is people starting to realize that being in these markets at these levels on a risk-reward basis is a very skewed proposition. Now, you throw in the fact that the Fed have bitten the bullet and started to tighten, and we can get into that in a little while if you like, but I think that's another story that is not what it seems. And suddenly this has kind of made people think to themselves, well, okay, if we do have a tightening cycle, if we are here, if we are looking at declining corporate profits, we are looking at PMIs that are in contraction, we're looking at slowing GDP growth. We've had a couple of decent jobs numbers, but the economic statistics coming out really aren't that good. Maybe I want to be on the sidelines. And really at these levels, and in markets like these where liquidity is certainly an issue, it doesn't take an awful lot more of that to crack them. You just need a few more people moving to the exits. In an absence of a multitude of bids, and you've seen what happens. So I think the economy is worse than people think. I think throw in China into the mix, which is something that nobody really has a full handle on, and suddenly, as opposed to previously when their tendency was to believe it would be all okay, even though they didn't know, now the tendency is they still don't know, but they're inclined to think it's going to be bad. And so you see these shifts in psychology, and they have a massive effect. And I think that's what we're seeing now.
Yeah, I mean, the key word for no crash in the stock markets is no major correction or crash yet.
Yeah, no, I agree with you. I mean, look, we've seen markets start the year very, very poorly. We've seen increased volatility. We've seen some moves which people had kind of forgotten could happen, but we saw on a regular basis back in 2008, and it's just started to make people feel. It's like when you're driving your car and you're tired and you're kind of dozing off a little bit, and suddenly you kind of realize that you almost fell asleep, and it sharpens your focus like that, and suddenly everything's very clear again, and until the next time you kind of feel a bit tired, you let it overtake you, and that's where we are in these markets, I think.
Now, one of our listener questions is from Hans Schmidt, and he wants to know the Fed's scenarios of interest rates. He sees two scenarios, and he wants to know if you agree, where the Fed tries a couple more token interest rate increases and maybe something breaks, or the Fed, just completely reverses course. What types of probabilities do you assign to both? Do you think they're actually going to attempt more token interest rate increases, or are they going to panic when maybe like the oil market blows up further or emerging markets or something like that?
Well, I think it's clear they want to, and it's clear they feel they need to, and realistically they do need to. So with that as a backdrop, let's kind of think about this in practical terms. They've done the one rate hike in December. The next meeting is next week. I don't think with what's going on there's a chance in hell they're going to raise rates next week, but they're going to want to keep it on the table. They're going to want to keep that. So as long as markets stabilize here and give them the ability to keep that next rate hike on the table, at least talk tough about it. That's what they're going to want to do. If we open next week with a couple of really bad down days, then all eyes are going to be on them. People are going to be looking to them to say something soothing. And look, I'm firmly on the record as believing that we'll see zero rates again before we ever see 1%. I don't think there's a chance in hell they can get these things to 1% without something happening. And when something does happen, they have inserted themselves as the superheroes who come along and save everything. So when we get a crack, and we will, I mean, it just happens. It's just the way of the world. When we get this crack, everybody's going to be looking towards them. And if they do nothing, people are going to get very frightened indeed. So the pressure's going to be on them. I suspect they will have to reverse. Whether they actually cut rates down to zero or not, maybe they won't do that, but I think they'll have to go to QE4 at some point.
Yeah, the academic Keynesians, the ones in, the university ivory towers that have tenure and stuff like that, they're calling for negative rates and all this other stuff more than just regular stimulus. But there's total carnage in the oil market right now. What probability is there of large oil-producing countries like Russia going bankrupt? And if maybe instead of them going bankrupt, this question is from one of my money manager friends of mine who reads your work. Do you think Russia then would consider selling some of their gold then to maybe buy themselves time?
It's a good question. Look, the simple answer with Russia particularly, and even more so with China, is we don't know. These guys they march to a different drumbeat to the West, and they're likely to do things that catch people by surprise. They've done it repeatedly over time. Russia is under tremendous pressure with the oil price where it is, of course. There's no sign of a let-up from the Saudis, but when you get the Saudi oil minister talking about how Aramco has no debt, how they can stand low oil prices for a long time, the fact that guys like that are coming out and saying that tells me they're concerned. They're trying now to force the situation. So they're just getting on with it. They're trying to get into other people's heads and say, hey, we can do this a lot longer than you. You might want to give up. That tells me that they're hurting, and they're all hurting. I mean, you look at the budget numbers in Saudi Arabia. You see, there's a massive hole these guys have dug themselves with oil down here. So at some point, oil is going to move higher. I don't think there's any doubt of that. But the danger here is that it stays lower for longer, and that's going to put increasing pressure on places like Russia, who are, as I said, apt to do things that will surprise a lot of people. And I have no idea what the Russians will do. But I do know that they're under tremendous pressure, and I do know that at some point something's going to have to give.
I have a theory on this. I don't think Russia will want to sell its gold. I think, Russia and China will arrange, my theory is that Russia and China will arrange some type of large currency swap deal where maybe China agrees to buy a long-term oil supply, maybe at $50 or $55 or something like that. They did this in 2009 to a smaller extent with both Brazil and with Russia. But, China gives them a whole bunch of freshly printed RMB in a currency swap deal for low interest rate for extra cash infusions, and then Russia sells some oil above market price that they can actually turn a profit on, and that would seem to be win-win, and then neither China nor Russia would have to sell their gold.
Yeah, look, I don't know if that's what's going to happen, but I don't think either country is going to be a seller of gold anytime soon, that's for sure.
My next question is about emerging markets. You've lived in Singapore a lot. You travel a lot. Does it look like emerging markets are on the verge of collapse? We see all these news stories coming out about Brazil and the Brazilian president being charged with impeachment charges coming due to corruption and the problems with Petrobras, which may go bankrupt in the near future. Are a lot of the other emerging markets, the commodity-producing countries, the ones that relied on oil and base metals, are they in very similar boats then to Brazil?
Well, the problem for most of these countries is just dollar finance debt. That's the Achilles heel. People tend to group emerging markets together, which is a nice, easy thing to do, but it's a flawed assumption. Brazil is not Indonesia, which is not the Philippines, which is not Cambodia, which is not Thailand. I mean, these countries all have their own situations. So it's very easy to say, yeah, emerging markets are in trouble, but you look at places like Vietnam and the Philippines, where there's some interesting stuff going on. There are certainly reasons to be positive about certain investments in those countries. India as well. I mean, India has its problems, but it certainly has. There are places you can invest in India that look very encouraging. The problem a lot of these countries have at the moment is just this enormous overhang in dollar-funded debt into a hiking cycle. That's what's really causing these markets some stress at the moment, and it looks like it's going to continue for longer. My partner Raoul has been banging on about the strong dollar for a long time, probably longer than most people, and he's been absolutely right. And he thinks from here there's potential for the dollar to have another very, very strong run. If that happens, if he's right, that's where we might see some of these countries start to get the kind of pressure they can't actually handle. Now, personally, I think there may be one more rally in the dollar. I have a feeling that it'll get cut short and reverse. But in the meantime, the strong dollar is by far the biggest problem facing all these emerging markets at the moment.
I agree with that, but it doesn't seem that anyone at the Federal Reserve, any of these Keynesian central bankers at any of these major central banks that are in major economies, no one seems to want a strong currency. But the dollar seems to be, being saved for last because it's the world reserve currency still. It's just very interesting that we have a situation where I guess, all these other emerging markets, they leverage their economies to China, and for 10 years it worked, where there was rising commodity prices, their own currencies were strengthening with higher commodity prices in oil and base metals and things like that. And now, the trade is in reverse, and they're stuck with the debt, and, their currencies are falling very rapidly. The commodity prices are falling very rapidly. The producers of these commodities some of them are insolvent already, but they're going to be insolvent in the near future. So it just looks to me in terms of size, with the emerging markets, with the oil markets, that these problems are global now, and they're even larger than the American subprime housing bubble.
Yeah, well, look, this is clearly a global problem. We're seeing a global slowdown. We're seeing a demand shock. We're seeing the kind of problems that can't be dealt with at an individual country level, which is why I think you've seen this for many years. You've seen this coordinated central bank effort. What we've found ourselves in now is kind of an every man for himself situation amongst the central banks, which is a real problem. As you said quite rightly, everybody wants a weaker currency, and fortunately for them, the US is obliging, and the dollar is by far the cleanest dirty shirt at the moment. That's not going to last forever, and at some point it's going to become something that the US is going to actively have to try and reverse, because it's just going to become too painful for them. For the moment, the guys in Europe are actually rubbing their hands at the strength of the dollar. The Japanese are doing the same thing. It's the one strong currency in a world where everybody wants a weak one. So at the moment, it's working. As I said, at some point, that strong dollar we're already seeing it hurt corporate profits in the US. We're already seeing 40% of the S&P's earnings are derived from overseas. That's a big hit. So it's a problem already. But the Fed have backed themselves into a corner. As we've watched this develop over the last several years, we're all standing here staring at the central bankers, watching what they're doing, and they've gradually been backing themselves further and further into this corner. Now, we can see the corner behind them. They can't. So we can see how close they're getting to it, and they can't. As they back themselves in, they're not going to know they've hit the corner until they feel their backs against the wall. And at that point, there's really nowhere else left for them to go. And it really feels to me that, if we're not there yet, we're no more than a step away. Draghi's comments yesterday, essentially, whatever it takes, part two, smacked of desperation to me. Here's a guy who's basically saying, we will do whatever we need to do. Now, at some point, the market's going to tell him to show him what that is. And I don't know. Is he going to go to negative rates? Is he going to come out with more QE? He's going to have to do something. He's already flagged that. It's going to hurt the euro, which is good for them. It's going to make it weaker. But if you look across the European banking sector, you'll see a world of hurt. You'll see banks in every country in Europe. Deutsche Bank went through its 2008 lows this week. I mean, this is not good. In Spain, the same with Santander. Look at the banks in Italy. Some of them are down 80%. There are real problems in Europe. And so what Draghi's going to do in the form of negative rates or extended QE, it's not going to have the same effect, bizarrely, that his whatever it takes speech did back in 2012, because you have this diminishing return of policy moves these guys are making. QE4 in the US is not going to have the same bang for it as QE3 had, and that's going to continue to decline. What are they going to do? They don't really have any other form of attack other than to do more of the same. And I think that's their Achilles heel. Everybody knows it, and they're going to start betting against it before too long.
If the dollar stays strong or continues to strengthen, I think it will break something either in the real economy. Maybe it's in the U.S. with corporations and their corporate profits. Maybe those corporate profits, they tend to be cyclical with the profit margins. Vitaly Katzenelson, who's a value investor, he did work on this with the profit margins and how they're cyclical. So they don't always just keep going up. They tend to rise and fall in cycles. But, something's going to break either in the real economy. Maybe it's the emerging market companies that have lots of dollar-denominated debt, like you said, or maybe it's the oil market where a strong dollar continues to hurt the oil price, or, maybe it's in the asset markets where a strong dollar hurts other asset prices and things like that. But I think something is going to break in the near future if the dollar continues to get too strong.
Yeah, look, it feels that way. I mean, asset prices have been climbing for years now, but they're only as high as the marginal bid, and the thing people forget, and I talk about this a lot, if you have a rising market like we've seen for the last 7 years, there is always stock for sale. At a price, there is an offer. I can guarantee you, I can find you an offer in anything that's going up because someone will sell at some price. What people have forgotten is when markets turn and we get a similar strength of move to the downside as we've had to the upside, sometimes there are no bids. It's not there's a bid, but it's down 10% or 20%. Sometimes there are no bids for things. And that's very, very dangerous when you have a lot of crowded trades, you have a lot of people on one side of all these trades, and suddenly everybody starts looking for bids. Throw in Dodd-Frank, which has taken bids away from the sort of investment bank proprietary books. They can't make bids and get in the way of this stuff now. And there is a chance that there could be a severe dislocation to the downside when we see a real panic move to get out of things.
If a lot of these oil producers go bankrupt, Grant, do you think then that this could trigger the banks, loan loss and counterparty risk, and similar to 2008? Do you think the bankruptcies for a lot of these oil producers is large enough to do similar or worse than to what the housing market and subprime did then?
Well, you look at the amount of debt outstanding in the next couple of years, and it's truly extraordinary. I mean, people have had the opportunity to finance themselves for the long term, but they like the mortgages back in the mid-2000s, people wanted the low teaser rates, and so they've all financed themselves for 1, 2, 3 years. So I forget the number now, but there's a tremendous amount of debt that's going to come due in the next 12 to 24 months. So at that point, yeah, we are going to see the kind of stress this puts the bank under. I mean, it's a different problem to 2008 because this isn't leverage on the bank's balance sheets. This is non-performing loans. This is old school banking gone wrong. But the fact that it's a different sort of problem doesn't mean these guys aren't going to need some sort of bailout. I mean, I can see that happening very easily. The governments and the central banks are going to have to decide, do we let these banks go this time because they've just done bad business, or do we have to jump in because it's systemically important? And they've already set down their marker in 2008, and it's going to be very tough for them to just say, you know what, this time you're on your own, because we've already heard tales of what a disaster that would be for the world and how the system would go down, et cetera, et cetera. So how do you justify not saving these guys? This is just another example of the corner these people have backed themselves into to me.
To add to that, we have a listener question from Cam White, and he wants to know if the current global financial system can be fixed, and what do you think are some of the main problems with the system itself?
Look, to me, there's one overriding problem, and that's debt. The debt levels have been allowed to grow to such extreme levels that, to me, it's almost impossible to see a way out of this without some kind of reset. Somebody somewhere is going to have to go bankrupt at some point in time. We can't stop that happening. That's what they did in 2008. They this whole phrase, it's a very hackneyed phrase now, but this whole idea of kicking the can down the road is absolutely right. But the debt has just increased, and at some point in the cycle, and it feels to me like we're there, you reach the end of these credit super cycles, and there has to be a deleveraging. That's what we're seeing. That's what all these forces, people are talking about them being deflationary forces, but you can argue, are they deflationary, are they deleveraging forces? I would argue that this is all part of this huge move to delever, which is where the natural market forces want to take us. So you can try to generate inflation all you want, but to do it by generating more debt, which is what governments have been doing for the last 7 years, you're just compounding the problem. And at some point, these are all cyclical in nature. All these phenomena are cyclical in nature, and there's an ebb and there's a flow, and we've reached the bad part of that cycle. And the sooner we realize that and try to actually manage the pain rather than avoid it altogether, the easier it's going to be. But I don't think there's any easy way out at this point.
Yeah, I agree. And, other than cheap gasoline and asset prices that are probably going to get cheaper, barring, the central banks and the Federal Reserve coming back in and trying another reflation of the asset prices, I don't think the guy on Main Street, which is, where we focus on, the guy on Main Street, not the person on Wall Street, we try to educate the person on Main Street. I don't think that guy's going to see any real beneficial deflation. I don't think his dollar is necessarily going to buy him a lot more purchasing power because, we see taxes going up across the board for the middle class person on Main Street. Their purchasing power is going down, their rent's going up, healthcare, tax, and all these other things are going up. Their food portions are decreasing, so they may pay the same price at the grocery store or the restaurant, but the portions are dropping. So that's, I think, the reality of the situation where, there's falling prices and the Keynesians say, like in Brazil, for instance, right? With the GDP falling in Brazil, they'll say it's deflation, right? But if you're on the streets in Brazil and you had a bunch of real in your bank account in the last year and a half, you lost already 30% of your purchasing power. That's not, real deflation to me. That's like stagflation for the guy on the street in Brazil then who had savings in cash and then got screwed even though the economy is getting worse. His purchasing power is down a lot.
Sure, yeah, no, I don't disagree with any of that. That's the world we find ourselves in, which is why, to me, this smacks of deleveraging rather than deflation.
Now, I have another listener question here. While recently on a panel with Michael Maloney, author, goldsilver.com, the Hidden Secrets of Money video series, you mentioned that your partner at Real Vision TV, Rail Paul, is looking to put 100% of his money into gold in 2016. What is Rail looking for to pull the trigger?
Well, I'm not going to put words in Rail's mouth, but Rail and I have kicked this around a lot, and again, it goes back to what we were saying at the first time, at the beginning of this conversation. All these currencies, at the moment, they've weakened and weakened and weakened, and we're left with the dollar, and the dollar is now the last man standing. It's going through the roof against all these other currencies. Rail's point, and I think it's a very good one, is that when the dollar finally runs its course and people either lose faith in that or they want to get out of the dollar, they just don't want to be in the dollar anymore, where do you go? And the only real answer left is gold. And so, at some point this year, Rail's on record as saying that he thinks that it will be time for that move. And at that point, it's time to put your money in gold. But, we don't know when that's going to be. He certainly thinks the dollar goes a lot higher between now and then. I think it goes higher. I don't know how much higher. I suspect I probably put the top a little lower than he does. But again, you have to watch these things play out. Making allocation decisions 6 months ahead of events is never a smart thing to do. You have to have a framework and then evaluate things as they move within it and be prepared to adjust it as you go along. So personally, I think gold's day in the sun is if not with us, then it's certainly very, very close. But look, I've been wrong a number of times in the last few years, and it's confounded me as to why gold's done what it's done. But I just get a sense now that this has all been part of this move that's had to happen. All these dominoes have had to fall in place for this to happen, and we had to get down to the last man standing being the dollar, and it feels like we're there.
Well, if gold doesn't have its big move soon, a lot of these gold and silver miners, the primary ones, they've been able to delay bankruptcy, for a number of years, a lot longer than many people thought. But I think they're running out of road. So if, the gold and silver price don't start to rise soon, they're going to hit real-world limits at these mines, and we're going to see a good amount of supply come offline in the near future.
Yeah, no, I think that's right. I mean, we know the pressures on these guys. We know they're struggling. I've never seen in my career, which you very kindly put at 20 years, but sadly it's 30. I've never seen any group of stocks in any sector in any part of the world as hated as gold mining stocks are right now, and that to me is a hugely positive sign. I think that's the sort of stuff you see at bottoms. It's the sort of stuff you see when markets can turn. I was looking today that the TSX Venture Exchange volume has dropped to its lowest in a decade. This tells me that people are just not looking. They don't want to own this stuff. And for a long-term investor, which if you're going to play cycles and things like mining and commodities, you absolutely want to be a long-term investor. These are the turning points you look for. So to me, you have to get your sizing right, which is the most important thing with any trade. But buying gold, if you haven't been long and been burned on the way down in a lot of these mining stocks, which a lot of people have, it's been a painful couple of years. If you're fortunate enough to have not actually had to ride that down, then I think taking a look at them now is a very sensible thing to do.
Yeah, there's just not a lot of capital available left in the industry right now. Everything's at penalty rates. Like the royalty and streaming companies were in a great position where they had a lot of base metal miners that were desperate to do deals to sell gold and silver streams and things like that. But they all the big, large gold and silver royalty and streaming companies have all done big deals in the last 12 months or so. So they're kind of out of capital now too. And, the price hasn't risen dramatically, so a lot of the lenders and things like that in Toronto and in New York are not interested in giving financing. So I think we're at a point where sentiment is obviously extremely negative, like you mentioned. It's going to be very interesting because I think we're going to hit a road, in terms of actual physical supply from the miners. Obviously if the miners are in an emerging market, their currencies have fallen against the dollar, but a lot of these miners, their costs have been offset with cheap oil and a cheap currency for an emerging market, but then they have dollar-denominated debt. So it's a tough balancing act that they've been able to do. They've been I have to give credit to the management teams at some of them. They've diluted a lot, they've misallocated capital and things like that, but they have been able to avoid bankruptcy a lot longer than I thought. I thought, the major, total capitulation with mergers and acquisitions that would have happened already.
Well, I think the point to remember here is what's happening in the precious metal space. This is nothing new. I mean, we see these cycles in commodities all the time. The difference being with precious metals, if you're looking at base commodities and you're in a bear market in base commodities, which we clearly are, there are things you can look for signs of a turn. You can look at economic activity. You tend to find people are much swifter to close copper mines and iron ore mines than they are gold mines, because who wants to close something that's basically pulling money out of the ground? So this is nothing different. The problem with the precious metal stocks is, what are you looking for as your sign of the turn? You're looking for what? You're looking for a weak dollar. Okay, fine. You're looking for central banks easing up on their money printing. Okay, what are you really looking for? There's no signal. This is very much a sentiment-driven market, and sentiment can flip from being abject to being euphoric without ever going to the place in between. So if you're following these markets and you've been long, it's been a painful ride, and you don't really know what you're looking for in order to sense there's a turn coming, except sentiment. And to me, the only time you can really start to get a sense that sentiment's going to turn is when it is as black bearish as it is right now. So they're the kind of things you look for. So whether we're there or not, I don't know. Nobody knows. The question everybody asks is always when. And it's the one question no one's got any answer to. And I think plenty of people can tell you what, and a ton of people can tell you why, and a few can even tell you how, but no one knows the answer to when, and it's the one question everybody wants. So keep an eye on the sentiment, and when you feel people have given up on these stocks, which it certainly feels like they have, that's the time where you want to start combing through the wreckage and figuring out which ones you want to own when the market turns.
Yeah, it's that sage advice right there. I think a lot of Wall Street, Grant, has sold. Leading up after the 2008-2009 crash, a lot of people had started buying gold and silver exposure. They made them a lot of money in the run up on Wall Street. The momentum traders did till 2011. They thought, we're out of the crisis. They sold their positions. That helped create downward pressure besides the chart movement. And I think now, after partly we started seeing this in 2015, we started seeing people start to sell their regular stock positions. And when we started having corrections in the regular stock market, I think the more corrections we have in regular asset prices, I think the more people will feel the need for portfolio insurance. So whether that's cash or physical precious metals, people are going to start going to those routes for insurance purposes and to reduce volatility and things like that. So the more I think the regular asset prices fall, I think the more money that's going to start going into gold and the mining shares and things like that.
Well, if you're right, and you may well be, as I said the point of my presentation was, it's such a small market. It doesn't take an awful lot of new interest to really turn things around. And momentum is a two-way street. People in times that just get caught up in, when they talk about momentum, all they can picture is downward momentum, because that's what we've seen now for 4 and change years. But momentum works in both directions. And when this thing does turn around, because you're talking about a physical asset, when it turns around, people are going to want to own that asset. And we've seen the damage done to this market in the last 4 years in terms of physical metal being moved into very, very strong hands. And if people actually want to own that physical metal, to try and entice it back onto the open market is going to take significantly higher prices. And once those higher prices start happening, they're going to be happening because people are starting to panic. And when people are starting to panic, they don't want to sell their gold. So I'm just waiting to see what this looks like in the other direction, because as bad as it's been on the way down and as painful as it's been to watch, I suspect, given the squirreling away of the underlying asset in the gold market, the move to the upside when it comes is going to be even more spectacular.
Yeah, I agree. It's kind of setting up like the 1974 to 1976 bear market after gold, I think, went from 35 to like 200, and then it had a really nasty correction for a few years, and a lot of people sold and left it. And then, after the big correction, it went down from, I think, 200 to 100, it got cut in half. And then I think it went up to 800 before Paul Volcker, actually started doing the right thing to save the dollar and raising interest rates. Basically he went against a lot of the stuff the Keynesian economists said he shouldn't do, but he did it anyway, and he managed to help the U.S. survive for decades more. Our next listener question is from Eric. He wants to know, for your personal precious metals portfolio, what percentage of miners versus physical metal do you have? And he also has a question about GLD. He wants to know what you think is wrong with it.
Well, look, I mean, the allocation between the underlying metal and the miners is something that will change all the time, depending on. Right now, I'd be apart from a core position in physical metal, I'd be looking to get far heavier in the mining stocks down here, because, as I said before, I just think the risk reward down here, given the backdrop we're seeing, is potentially extraordinary. And I've spoken at a couple of investment conferences in the last sort of 2 months, and some of the real superstars of the industry who've been around, who've seen these cycles before many, many times, are absolutely salivating at the prospects they see for the next time we get a bull cycle. So right now, I think it's a time, if you're invested in gold as an asset class, it's time to shift some of the allocation from physical metal into the mining stocks. And sorry, what was the second half of the question? I've lost my train of thought now for the second half.
It was about GLD,
GLD,
and he wants to know what you think is wrong with it.
Well, look, to me, there's one very simple thing wrong with it. You don't own gold unless you buy $11 million worth of GLD. You can't swap the shares for gold. Does there need to be anything more wrong with it? More wrong with it than that? I just think the people who think, I need to own some gold, I'm going to buy GLD. Well, you haven't solved your problem. We're not going to know if there's anything wrong with it along the lines of all the stories about whether the gold's actually there, et cetera, et cetera. We won't know that until it's too late. So if you're buying GLD because you think it's a trade and you think gold's going to go from $1,100 to $1,200, by all means, buy GLD and flip it when it gets to $1,200. That's perfectly acceptable. If that's what you're looking to do, there's nothing wrong with GLD. If you're buying it because you feel like you want to own some gold, then there's one very obvious flaw in it. You don't own gold. To me, it's that simple. It's a trading vehicle. It's not an investment.
Yeah, hasn't there been a few cases where people who have over $11 million worth of shares of GLD have tried to redeem, and they've been told by the custodians, who are the large Wall Street investment banks, that they can't redeem and get their gold?
Well, look, I mean, as legend would have it, yes, but I mean, it doesn't matter if that's the case or not. If you want to own gold, why would you take the risk that those stories might be true? it's a nonsensical risk to take. If you want to own gold as protection, as insurance, own gold. Pure and simple. You can do it in any city, anywhere in the world. You can go and buy physical gold. It's not a difficult thing to do. If you just want to have exposure to the price, fine, buy GLD. But it's not going to do for you what physical gold will do for you in the event of a dislocation. It just won't. You'll get some price appreciation, but if you want to own your physical gold, or if a ton of people want to own the physical gold that's in the trust, you may have problems, and you may not, but I just don't want to take that risk. I don't see the point.
Yeah, I agree. I think there's better options for trusts like the Sprott Physical Gold Trust, although, there is redemption, but I think you need a certain amount, but it's a lot less than GLD. Plus, they have the vaults allocated and fully audited yearly independently and things like that. So there are other options. I think also there's the Central Fund of Canada too, but, that's if you just want like geographical diversification. People should definitely own some physical precious metals. And probably continue, dollar cost averaging maybe a little bit every month. Another listener question we have is he travels frequently, and he knows that you've lived in Singapore for a while. He wants to know where in Singapore is good to store some physical gold because he travels there, and he wants to know where it would be easier for him to store there.
Sure. Well, there are a number of options in Singapore. And since 2012, in the budget, Singapore has been actively promoting its place in the world as a centre for trading gold. So there are plenty of options. I'm actually on the board of a company that stores that. I won't use your site to advertise them, but I'm very happy if people want to email me with a specific question about Singapore. I'm very happy to put you in touch with these guys. I wouldn't be on the board if I didn't think they were the real deal. But there are tons of options in Singapore, from Brinks to Malka Ahmed, the usual suspects. You'll find them all in Singapore, and it's a good jurisdiction to own gold in, I think.
Yeah, I think it's very important that people, if they have the financial ability to do it, because not everyone has, 50 grand or a couple $100,000 in order to be able to store gold in 6 different locations in different countries and things like that. Ideally, in a perfect world, people would have the ability to do that. But, hopefully there'll be new abilities. I think there's the new one that's BitGold that allows people to store pretty cheaply in a bunch of different countries. But hopefully there'll be other options soon in the near future where people can do it for a relatively decent amount of money.
No, that's very true. And BitGold, Roy and George, the two guys behind BitGold, are incredibly bright young men, and they're doing some extraordinary things. We don't know. It hasn't been tested. It's a great idea. They've built a fantastic platform, but we haven't seen it through the cycle, so the jury's kind of still out. But it's very interesting. This merger of gold and the blockchain is going to be something that warrants a lot of attention in the next couple of years, I think.
My last question for you has to do with Real Vision TV. What prompted you to start it, and what do you like most about it so far?
Well, we set it up because we genuinely felt that people were not really getting the real story about A, what had happened in 2008, and B, the changes that have been made to the world we live in with regards to finances, and they are seismic. And so, our contention was that finance has attracted the very brightest minds in the world for nearly 40 years. You had all these people coming out of college, the smartest people in the world, and they figured, if I want to get paid, I need to go into banking. That's starting to change now, and people are moving into tech and biotech. But you've got 40 years of the brightest minds on the planet scattered all around the world in their various little corners of banking. And so we wanted to go out, and instead of relying on sound bites and stuff to sell commercials, let's go find these people, the really smart people, and let's sit down and talk to them. Not for 2 minutes, and not with them screaming and shouting over somebody else, but let's really sit down and understand what they think about the world, what they think the right things for people to be doing with their money are, what they think the problems are, what they think solutions are. And in terms of what we're happiest about, we've managed to achieve what we set out to do, which is unbiased platform which showcases the best independent financial thinking you'll find anywhere in the world. And our subscriber base have absolutely embraced it, and they're almost fanatical in this thing. And the people that come on, as you found out, Jason, people are very gracious with their time, and they'll come on and share their wisdom and share their thinking with people. And it's, for me, it's been a real treat to travel around the world and speak to some of the real legends of finance.
Yeah, I mean, almost everyone has like 20 minutes to spare. Although, the billionaires, like I heard Bill Gates lately, that he has like every minute in his calendar of every day accounted for, but most people don't. Most people have 20 minutes where they can do an interview or something like that.
Well, look, it's a good chance for them to engage in a conversation with peers rather than journalists, and sit down and actually have a conversation, not be caught up in studio lights and ad breaks and commercials, but actually sit down and have a reasoned, intelligent, in-depth conversation. And it's amazing what comes out of these things once you get people talking. The places people go and the things they come up with are truly extraordinary.
I really love educational technology. The university school system, the student loan debt problem, it's a bubble. It's creating, wage slaves and debt serfs for a lot of these kids. So I applaud what you're trying to do. I think it's amazing. A lot of these kids who are going for an MBA, they're paying, if it's not a big name school, they're paying all this money to learn skills that so many other people have. They're going to end up in debt, where if they would have just bought a couple dozen audiobooks and maybe subscribed to your website or a few other things, they could have reduced their costs and still learned a lot of valuable skills. So I think there's going to be enormous disruption in the old university system, the old paradigm in the near future, thanks to websites like yours and the other innovation that's going on in financial technology and educational technology.
Well, we certainly hope so. That's what we're trying to do.
Great. Well, if our listeners want to check out Real Vision TV or subscribe to your newsletter, how do they do so?
RealVisionTV.com will take you through to Real Vision. And my website for my newsletter is TTMYGH, thingsthatmakeyougohome.com. And they're both up there. You can come along and check them out. It'd be great to see you.
Excellent. Well, thank you again for your time, and hopefully we can have our next conversation sooner. Hopefully I don't have to wait over a year to speak to you again.
I hope so too. Thanks for having me on, Jason. I appreciate it.